Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody. This is Ron LeGrand coming to you with another edition of The Mentor, an ongoing series of podcasts dedicated to make sure that you get more out of life, make more money, pay less taxes, which is the reason our guest is on the podcast today, and retire wealthy. I have Mr. Quincy Long on the phone today. And Quincy, I don't really know if you are the co-founder or founder of Quest, but tell us who you are, and you probably know better than I.
Yes, Ron, thank you for having me, by the way. And I am basically the founder of Quest IRA, and we are the fastest growing and popular self-directed IRA provider in the country right now. I mean, we're just really growing really well.
Well, I'm certainly sending all of my clients to you, and you got my IRA as well, so I hope you do well. I know you will. Listen, you come to all of our boot camps, and you bring a team, and we do everything we can to get our listeners to get an IRA. So in the short time we got together today, we got to make sure they understand how important it is and why they need to get one, and make sure that they are clear that there's nothing stopping them from getting an IRA, and where they should get one and what it costs and all of that. So,
okay.
First of all, there's a traditional IRA and there's a Roth IRA, and I tell everybody to get a Roth because tax-free is better than taxed. Agreed?
That's true.
Okay.
Roth is better if you can qualify for it on the income rules. That's
well, that means what is the cap? What is, as we record this, what is the most I can make to have a Roth?
I believe in the for 2018, I believe the figure is 199 as a married couple filing jointly.
Okay, and that's net operating income after all my other deductions.
That's right, the modified adjusted gross income. So for most people, that's the bottom line of the first page of the tax return.
All right. However, if I don't make that, if I make more than that, which I should be proud if I do. If I make more than it, doesn't mean I can't have a Roth. It just means I can't contribute to a Roth.
That's right.
Let's explain that. Okay. Go ahead. Tell us what we need to do.
What you would have to do, and I do this every day, every year, Ron, by the way, is because I make above the income limits for my wife and myself. So what we do is we put the money into a traditional IRA. And because we're covered by a retirement plan here at Quest IRA, I have a 401k plan for the employees, then I'm not qualified to deduct that contribution. But it doesn't matter because I then immediately convert that to a Roth IRA. And because I didn't take a tax deduction on my tax return, then it's a tax-free Roth conversion to me. And that's called sometimes in the industry a backdoor Roth.
All right. Well, I'm going to translate that, Quincy, because I got a feeling they don't know what you just said. What you just said was, regardless of my income, I can have a Roth as long as I open a traditional first, and then the rules say I can transfer my traditional to my Roth. I just can't contribute to that Roth as long as I'm over 199. And of course, I'm going to pay taxes on that transfer that year. But now I've got a Roth, and now the key is, of course, what do I do with that Roth? And that's the next part of our discussion here.
All right.
Why do I want a Roth? Why do I want an IRA at all? And I've always told everybody, you're never going to get wealthy contributing $6,000 a year to your IRA.
Nope.
But you can if you take a little bit of that money and invest it and leverage your brain into something that can get you a whole lot more money back.
Exactly.
Tax-free. And since most of our listeners are real estate entrepreneurs, they understand the power of taking a $100 earnest money deposit and flipping a house and turning it into a $20,000 profit. And that's the point I want to make sure everybody gets. It's not about contributing. It's about profit. Use 100, get back 20 tax-free in your IRA, and obviously you can decide what goes on after that, because there's a whole list of things we can invest in, isn't there, and grow tax-free.
A whole bunch.
Why don't you while we're on the subject, why don't you tell us what we cannot invest in with our Roth IRA?
Sure. You cannot invest in either life insurance contracts or collectibles. Everything else that can be documented as far as the title goes is likely to be acceptable to the custodians that offer self-directed IRA plans.
And that leaves a long list of things we can do. I know we can't buy art, can't buy alcohol, can't buy even coins except gold, U.S. gold minted coins, right?
Well, U.S. gold minted coins and bullion grade of metal, whatever the form is, you can buy those.
Just not coin collections.
Just not coin collections.
That means we can buy stock, we can buy real estate, we can buy mortgages, we can buy crypto, we can buy anything we want that could be perceived as an investment other than those list of things.
Right.
That means I could even make you an unsecured loan with my IRA, couldn't I, Quincy?
If you're nuts, yes.
That's right. Okay, but that's correct. All right. So, is there any age by which I cannot open a Roth IRA?
No, the Roth IRA rules allow anybody that meets the income requirements, that is, to have enough compensation type income to make the contribution and not over the limit. Anybody of any age can open a Roth if they're within that limit.
Okay, well, what if I don't have any earned income?
Well, you have to create some, because you can't make a contribution to a Roth without earned income unless you're married to somebody who has the earned income. Then you can rely on their income, assuming you're married filing jointly, to make your contribution. Okay,
so of course I could always start my own LLC and pay myself.
Of course.
Okay, so if I wanted to make a $6,000 contribution, I'd have to have at least, $6,000 worth of income?
That's right. Compensation.
Okay. And is there any reason that I couldn't loan my LLC the money to pay me a salary?
Well, hopefully you have legitimate business income, but if it takes a loan to overcome that, I suppose that's okay. But you still have to have legitimate.
Got it. I got it. So if I'm going to open an LLC, there probably ought to be something I do with it to make some money, huh?
Exactly.
Like flip a house or something like that.
Something like that.
Okay. So my point is, we can't sit around and use I don't have any income to reason not to open a Roth. And I'm telling you this, Quincy, because you know as well as I know, everywhere I go, every day I take the platform, I pound on people to get a Roth IRA. And of course, I send them all to you. Regardless of the fact that you're not sending me any money, I send them all to you.
Well, we do sponsor your lunches, though.
You do sponsor my lunch. I guess I do get a free lunch out of it along with the rest of the class. But I can't, I look out at the class and I pound them and I pound them and I pound them. And even when it's all over with, some of the people in the room still don't have an IRA. And for the life of me, I can't figure out why they don't go back there and sign up and get an IRA.
Well,
I don't know what they're missing. I don't get it. So how much money do I need to open an IRA, Quincy?
Well, it doesn't really matter. The dollars, we don't have a minimum dollar limit. Of course, so the way I answer that question, Ron, is you have to have enough money in there to do a deal.
Yeah, which in reality is a $100 deposit. As long as you understand a little bit how to do real estate flips without writing checks or having your IRA write them.
Right.
Okay. But obviously we would want more money in there than that. I mean, there is a $6,000 maximum contribution limit, but I think some people are under the impression that I got to have $6,000 to open an IRA, and that's why I asked that question.
Yeah, no, it's not. It's $5,500 if you're under age 50, and $6,500 if you're age 50 or over by the end of the year.
All right. Now, with a traditional, I got to start taking that money out when I get to be 70 and a half. But do I ever have to take money out of my Roth?
No, not you.
Okay.
If you leave it to somebody, they do have to start taking money out of the Roth, but not you. The original account owner can leave it in there for the whole life.
Okay. And just let it grow tax-free and compound and compound and compound.
Isn't it amazing?
Yes, it is amazing. It's a gift from the IRS. Have you heard any rumors that the government's trying to screw with this thing and change it so they can actually start collecting taxes on it?
Well, you always hear rumors, but there's nothing substantive that I know about. In anyway, they did change the rules, they would likely go ahead and grandfather in the existing account. So that's a good argument for going ahead and getting an account as soon as you can.
I always tell people you better get yourself a Roth IRA and go like a bat out of hell before they change it. Because I think sooner or later they're going to get around to it, because there's an awful lot of money sitting in people's IRAs that the government's not getting taxes on, and they're in a cash-raising mode right now.
Especially, Ron, after the tax rules were changed to allow people to do the backdoor Roth. I will note, Ron, that in the tax bill passed by the Trump administration and Congress, it did say specifically you could still do the backdoor Roth. They made sure and mentioned that specifically in the conference report. So I thought that was interesting.
No kidding. And by backdoor Roth, you mean from a traditional to a Roth?
Yes, the conversion.
Okay. So listen, what if I'm on a job and I got a 401k and now I quit my job or I get fired? What do I do with that money?
You move it over to a self-directed IRA, and of course you move mostly your 401k into a traditional IRA, unless you had a Roth 401k at work, and then that part goes into a Roth IRA, and you should be free to move that money whenever you quit or get fired.
So if the 401k while I'm on the job, I'm not in control of, but when I don't have the job anymore, I can make them put it in my traditional.
Right.
Then I can transfer it to my Roth, all or part of it. Don't have to transfer all of it.
Exactly.
Keeping in mind that it is taxed that year, and that's a subject you have with your CPA, folks. Maybe it's the year you should move all of it, or maybe it's not. Maybe next year you might be in a lower income tax bracket. I don't know. And neither does anybody else except possibly your CPA, but even he don't even know your plans. So you have to tread carefully on that one. And I always tell people, Quincy, there is no reason for you to move your money from a traditional to a Roth if you're just going to let it sit in a Roth and not do anything with it.
Well, that's true with one exception, and that is in order to have a qualified or tax-free, penalty-free distribution from a Roth, you have to have had a Roth somewhere for at least 5 tax years. So if you're approaching, especially your mid-50s, and you don't have a Roth, get one real quick, because you want that tax-free status to get there as soon as possible. So,
got it. So your point is, even if I have to transfer $1,000 to get a Roth, I'll have a Roth, and my 5-year window starts.
That's exactly right. And the other thing is that, because I agree with you completely, the other thing to be cautious when you're talking about Roth conversions is that with the new tax bill, you can no longer change your mind about the Roth conversion. Once you hit the button to convert it, it's converted, and you can't go backwards. There used to be you could go backwards. You can no longer do that under the new bill.
I'm not sure why anybody would want to go from tax-free to taxed anyway, but I'm sure there must have been a reason. Okay. What are the self-dealing? We got to go over the ugly now. We got to get into the dark side. What are the things that I better not ever do with my IRA, whether it be traditional or Roth?
Well, so there's a list of things called prohibited transaction rules, and they all start with the proposition of who's a disqualified person. And a disqualified person is simply somebody who is too tightly tied to the owner of the IRA to be an arm's length transaction. So the list starts off with the owner of the IRA is disqualified person to the IRA. Now that seems kind of weird because it's your account, right? Well, you look at it, Ron, like it's Mr. Ira's account, and you're a fiduciary or caretaker for Mr. Ira, and all of your decisions have to be made in favor of Mr. Ira. And sure, Mr. Ira will die eventually and give you all of his money, but until he does, you're like a caretaker for Mr. Ira's funds. So you're disqualified, your spouse is disqualified, your parents, grandparents, and on up the line are disqualified. Your kids and grandkids and their spouses are disqualified, and any corporation, partnership, trust, or estate owned 50% or more by any of those people I just mentioned are disqualified. and disqualify the entity, you disqualify directors, officers, shareholders, that sort of thing. So that's a list of people who can't do business. And then the second part of it is, what can't those people do with your IRAs? You have a question, Ron? I'm sorry.
No, I just wanted to clarify that we heard the term more self-dealing, and that's what that means. You can't deal with yourself, and yourself is that broad definition that you just gave.
Exactly.
The word you means all of those people in that entire group.
That's right. Okay. And so what you can't do is you can't buy or sell property from the IRA into one of these persons, or can't contribute either. You can't extend credit between the IRA and one of those disqualified persons. So that would mean you can't, for example, loan the IRA enough money to do a transaction. The IRA has to come up with his own money, and you can't extend services to the IRA or facilities or goods to the IRA. So, for example, you couldn't have a piece of land in your IRA and then go build a house on it with your materials and your contractors, because the IRA would have to pay for all of that. And you can't have any kind of direct or indirect use of or benefit from the IRA's assets for any of those people. So, for example, if you had a beach house in Belize, you can't go stay in the beach house, not even if you pay fair market rent. The IRA has got the asset. The IRA's got to get all the benefit. And so you can't interact with it in any way. And finally, any kind of direct or indirect benefit, and that's really where it gets sticky and squishy, to any disqualified person from any transactions has got to be with people other than those disqualified persons, and that's directly or indirectly. So, for example, Ron, I couldn't sell you a house for $1 and then have you convey that to my IRA for $1, because that would be an indirect violation.
Right. And pretty easy to track, too.
Good.
And I always tell everybody the IRS is a gorilla you do not want to dance with, because they're going to win. And it is true, Quincy, that the IRS is about the only entity out there that can grab my IRA, isn't it?
That's true. They can grab it, and luckily you don't have to pay a penalty if they grab it.
Okay. So what if I get caught doing this self-dealing stuff? What can they do?
Well, effectively, the rule says that if you get caught doing the prohibited transaction, then your IRA ceases to be an IRA as of January 1st of the year in which the transaction took place. And what that means is that typically they don't catch these things for sometimes several years. And if they audit you and catch you, that means all the income you've been making in that IRA that you thought was tax-free was all of a sudden taxable income to you, and they can penalize you in various ways.
Penalties and interest.
Penalties, interest, right? And understatement penalties, and it's just a mess. Don't do it.
Is there a limit on how far they can go back?
Well, that's an interesting question, Ron, because the penalty for doing a prohibited transaction for the IRA is that the IRA is deemed to be distributed. So some people say that, well, once you pass the statute of limitations period, then you're probably free of that. But the IRA typically will have another disqualified person involved, and there's no relief for that person. So the disqualified person, assuming it's somebody other than just yourself, the disqualified person would have some additional penalties to pay from their side. And so also most cases that we've seen where they've done prohibited transaction, like in the Fleck and Peak and Fleck case, they said, well, that's a continuing prohibited transaction. So even though the transaction took place, it was a loan guaranteed by them, which they can't do. Even though the transaction took place 8 or 9 years before, it still bit them in the butt because it was a prohibited transaction. And because the loan wasn't paid off for more than whatever the statute of limitations is, they went ahead and declared it to be a prohibited transaction. So basically, don't get complacent with the rules, because oftentimes it's a continuing prohibited transaction and they're going to bite you anyway.
So in other words, just understand what the rules are and don't violate them, and then you don't have to worry about where the skeletons are buried.
That's right.
And to recap, that means you cannot loan or borrow money to your IRA or from your IRA with any entity you control or all of those use. And you can't live in any property that the IRA owns, nor can anybody else in your group. And you can't put property in or take property out of your IRA.
Well, you can take it out as a distribution, but you can't sell it yourself or whatever.
Legitimately. Right. Yeah. Okay. In other words, you cannot be personally compensated for any of the activities of your IRA until you get ready to withdraw money and do it the proper way.
That's right.
Okay. Here's another question. This one's on a little gray, I think. Okay. We all know that if my Roth IRA is going to buy a house, somebody has to make that decision, and we all know who that somebody's going to be.
That's right. Self-directed IRA.
Tell me, where's the line here?
What's that?
What's the rule and where's the line?
Well, the rule is that the interesting thing about this, and I think I know where you're going with it, is that there's always one disqualified person involved in the transaction, and that's you, because you're a fiduciary or caretaker for Mr. Ira's funds, right? So the question is never, is there a disqualified person involved, but rather, is there a disqualified person involved in an impermissible way? And one of those impermissible ways is a direct or indirect benefit to either the fiduciary, in other words, the IRA owner, or any of those other disqualified persons that we mentioned. So the question, when you say, can I do something or not, you got to figure out whether the IRS can make any argument that either directly or indirectly, any of those disqualified persons is benefiting. And if so, then you can't do it. So when you're talking about things like finding investments, typically that's not a deal that you're providing services, you're merely looking for investments. And I think that's pretty legitimate, because otherwise, how could anybody do anything without an advisor, right?
Correct.
So you can look for investments, but when do you remember, one of the things we said you couldn't do was provide services to your IRA. So the question becomes, well, when do you cross the line between just being a good fiduciary and making sure Mr. Ira has good investments and providing services? So it kind of gets to be a questionable area, a gray area. But most of the time, if you're selecting investments and you're doing investment type activity, you shouldn't have a problem. If you're doing any kind of active activity, such as flipping houses a whole bunch, that becomes business income, and then you get into these other issues.
All right. Well, in other words, if I've got a house and I want to put a tenant in it that my IRA owns, then I probably shouldn't be the one handing them the keys and
well, again, nobody knows where the line is, Ron. That's the trick.
I know. That's why I'm trying to get you to come up with it.
I know.
That's why I got you here, man.
You have, the better it is. But
all right.
Most people, when they buy rental property, they go ahead and handle the, putting the tenant and they
or have it handled. But the point I'm trying to make is, come on, everybody's aware that somebody has to make the decisions on what the IRA buys. I never really did think that ever crossed the line.
Right.
But of course, we do not want our name on any documents on anything that has anything to do with our IRA in any way, shape, or form.
Well, that's right.
We certainly don't want on any kind of a check coming from any IRA-related property.
What you can't do, Ron, is contribute your services. For example, if I started Quest IRA with, believe it or not, $16,500, and let's just say it's more successful now than that, I could not have donated my time for the last 15 years and not had a problem, because I'm clearly providing services. That's not the same thing as having an investment that you find that's a good investment. Those are two different things.
But if I'm over there painting the walls with my own hands, that probably crosses the line, eh?
I think that crosses the line, yes, sir. You can hire the painter, but you can't go paint it yourself. I agree.
Okay, so I can hire the painter? You don't think that'll create a problem?
I don't think so, but nobody's going to be able to give you a firm answer until you take it to court. And I'm not really interested in going to court myself.
if you guys are listening, why don't one of you go ahead and take it to court and let us know?
Yeah, that's a great idea, Ron.
Because frankly, I got enough arrows in my back. I've done enough pioneering, and I just send somebody else do it and let me reap the benefits of it. All right, talk to me about this UBIT thing here. You brought it up, so now we got to discuss it.
Okay, well, it's not real hard to understand. Basically, there's two parts to it. If you directly or indirectly through a non-tax entity own a business, then that's business income. And because it's a non-tax entity, such as a partnership or an LLC taxed as a partnership, then the business income flows through to the shareholder. And business income, as opposed to investment income, is subject to taxes, even if it's owned by an IRA. So a clear example of that would be my 401k plan, which owns an LLC, a share of an LLC that owns, in turn, a restaurant. And because that LLC is taxed as a partnership, whatever income the LLC makes, my share of that is taxable, and I have to file a 990T tax return. The second...
So, before you go on, that income goes into your IRA, then you pay taxes on it?
No, not me. The IRA pays taxes.
So your IRA pays the taxes, not you, the IRA owner.
Right.
What if the IRA doesn't have the money to pay taxes?
Well, then it's got a problem, just like you have a problem if you don't have the money to pay taxes.
Okay. And if it's a business income, it's taxed at the maximum tax rate, isn't it?
Well, it goes up to the top rate at about $12,500 of income, as opposed to in the several $100,000. So that's right.
Well, I'm going to get clear on this now. My IRA makes, I don't know, let's say it makes nets $100,000. Am I taxed at the top rate or the individual rate?
You're at the top rate for any income above about $12,500. So in that case, it would be 88.
That's a sliding scale now. I mean, the rate goes up to 37% for an individual in chunks.
Right.
So I'd have to be somewhere between above $500,000 for it to be at 37, or is it going to be taxed at the lower rate if I make less?
No, I'm afraid not. It's trust tax rates, so you got it right.
Which is 37%.
Right.
Okay, that's the point. That sucks. All right, so
well, it does or it doesn't. We could have an extended discussion on this, but let me go over.
I'm going to give you your answer before you even get into the discussion, because I bet you're going to say it still may be better to have the other 63% tax free for the rest of your life than to do it outside the IRA and pay taxes on the gain as well. Is that what you were going to say?
It's something like that, yes.
Okay. All right. Go ahead. You were in the middle of a statement before I rudely interrupted you.
Yeah, no, the other two circumstances where your IRA might have to pay tax is if it owns and rents personal property as opposed to real property, which is kind of a weird exception. But the classic example here is if you had a mobile home in a park and that mobile home was not declared to be real estate because somebody else owned the park, then that income, rental income from that would be taxable. On the other hand, if you sold that mobile home and collected interest, that's investment income and that's okay. So why they made that distinction, Ron, I don't really know. And it's not really affecting too many people. The thing that does affect most of the people, not most of the people, but many more people, is the debt finance rules. And that is simply if you're debt leveraged to a certain extent, to that same extent, your IRA's profits from that investment are taxable. Let me give you an example. If I'm 90% leveraged, or let's give a more realistic example. If I'm 70% leveraged on the real estate and my IRA put down 30% and then got a 70% non-recourse loan from a bank or whatever, then 30% of the income is tax-free and 70% of the income is subject to these taxes. And that's an oversimplification of something that's a bit more complicated, but that's a good
Well, let me give you an example. If I take over a debt of $200,000 and I sell with no money, and I sell the house for $250,000, then I'm going to be taxed on the $50,000 gain.
That's correct. Yep.
Okay. All right. And so that's if it comes with a debt already, or if I create a debt before or after I buy it.
That's right.
Correct?
That's right.
Okay. Well, I know the IRA cannot guarantee debt, so the only other place it can create debt is from a non-recourse lender.
That's right.
Which is usually a person, but there are non-recourse lenders out there that will lend to your IRA, aren't there?
That's correct. There's a couple of them. The biggest one being, well, I don't know if you want me to say the name, but
I don't care.
North American Savings Bank is the biggest IRA lender in the country. There's also one called First Western Federal Savings Bank, both of which have structured programs for this kind of lending. But it doesn't mean you can't get it from, as you said, taking over a deal subject to, or also getting
owner financing,
non-recourse loan.
Or owner financing. Okay. So if I want to buy a house and rehab it in my IRA, I could borrow the money from a private lender.
Right.
And not recourse. Therefore, it's okay. The rules are okay.
Right.
But then if I did sell it and pay it off, it is going to be a taxed event, correct?
That's right.
All right. Now, you said if my IRA operates a business, and I also know that can be a little gray line. For example, if I buy a piece of land and I develop it into lots, I'm a developer, and that's a business.
I agree.
And that's going to be taxed.
Right.
But if I buy a piece of land and then I decide to sell that piece of land, then that's probably not a taxable event.
That's true.
Now, here's the one I want to discuss with my students from time to time.
Okay.
If I'm just flipping properties inside of my IRA, and I'm flipping and flipping and flipping, pretty easy for the IRS to come in and say that's a business.
Pretty easy because, basically at that point, a house is no longer a capital asset, but a piece of inventory. So if you think about going down the street and seeing the sign say UGG buys ugly houses, to those franchises, a house is literally a piece of inventory. It's a big piece of inventory, but it's still just a piece of inventory. And anytime you have a business of selling inventory to the public as a normal part of your business, that's going to be not investment income, but business income.
So would you suggest if I do a lot of wholesaling houses, for example, in my IRA, maybe I should probably have another Roth IRA that doesn't wholesale houses? Or is that going to help?
Yeah, well, no, it would help. I mean, certainly if you're going to have a situation where you're going to do if you're going to do business income, let me just state it this way. If you're going to do business activity in your IRA, and remembering you cannot do the business yourself, it has to be run by somebody else, then the solution is to do that business through a taxable corporation, let the corporation pay the tax, and then remit the dividends tax-free to your IRA. And if you think about that, with the new tax law changes, that would cut the rate down to 21%. So that may be a viable strategy as long as you don't run the business.
And let me think about that, because you're right. In other words, my IRA could own a C Corp that buys and sells houses. And the biggest problem with a C Corp is you taking money out of it without called the dividend.
Right.
But in this case, the money goes into the IRA anyway. So taking money out of it is not the issue.
Right. Well, of course, you have the personal holding company rules and stuff you got to comply with. So this is not something to just get a wild hair up your whatever and do it. You want to consult with an attorney or CPA familiar with the personal holding company rules and make sure that you're doing it right. But in general, that's the correct statement.
Okay. Well, that's good to know. So now one last thing, because we're already over time. Let's talk about the CISA and make sure everybody understands what that is, and then how we can get more information from you.
Okay. The CISA is the Coverdell Education Savings Account. And it's basically kind of like a Roth IRA, but only for education expenses, in the sense that you don't get any deduction for putting the money into the account. But when you take it out for qualified education expenses, it's tax-free. And the thing is that qualified education expenses include everything from kindergarten all the way through college. You have up until age 30 to use it before it has to either be distributed or given to another related party that's under age 30.
So you're saying I could open my kid a CISA and go do a deal in it with $100 deposit, and here comes 20, 30 grand back, and that will pay for my kids' educational expenses all the way up until they turn 30, which includes what? What's an educational expense?
Well, it's pretty broad. It even includes, tuition, private school tuition, college tuition, books, bags, can even include, in certain circumstances, computer equipment if they need that for school, and who doesn't these days.
They all do. So all I got to do is help my kids, CISA, earn the money instead of writing checks to put them through college like most of America thinks you need to do.
Yeah, and by the way, Ron, whatever you think you're saving and for your kids, it isn't enough. My daughter elected to go to SMU in Dallas. That's Southern Methodist University. And believe me, it's pricey.
You mean it costs more than you expected?
Yes.
Okay. Well, I always tell everybody, if you're putting your kid through a cheap college, you only need one or two deals. But if it's Harvard, you better get going. You'll need more than one or two deals. So, either way, though, you can have a CISA for each child or grandchild, and even for children you don't even know, as long as parent or guardian sign on them. Correct?
Well, unfortunately, Ron, mine are already over the age limit. So sorry about that.
Which is 18, which we didn't mention.
That's correct.
These things have to be open before the child turns 18, or it is too late, right?
That's right.
Okay. All right. Well, is there any other thing that you think we should probably mention before we get off of this that was very important? That
the only thing, Ron, that I would mention is that the health savings account can also be self-directed, and that is the best account out there in the sense that you get to deduct the money you put in there regardless of your income level. And when you pull it out for broadly defined qualified medical expenses, it's tax-free. So it's the only one that goes in tax-free and comes out tax-free.
Okay, so tell everybody what a health HSA is, health savings account.
Well, it's an account that you put the money in to, as I said, save for your qualified medical expenses, and that goes everything from doctor's visits to eyeglasses to psychiatric care to
deductibles. Can I use it for deductibles?
No, it's for medical expenses, not deductibles, and obviously you can't double bill. So.
Well, I mean, my doctor wants. I'm sorry, I meant copay. Can I use it for copay?
Yes, if as long as it's not covered by insurance and you haven't used that same expense to deduct on your Schedule B or Schedule A, sorry, then it's qualified pretty much.
How much can I put in an HSA?
For
married couple.
Married couple, it's going to be $6,900 for this year, and you can add $1,000 for if the person is over age 55, not 50, but over age 55 by the end of the year.
So I get to write it off when I put it in and don't have to pay taxes when I take it out? Is that what I heard you say?
That's correct.
Wow. Can my HSA buy a house?
Yeah, mine owns son.
Well, look at that. So I can take this same HSA and buy a house, and here comes the money. I don't have to put it in, and then I can literally have my medical expenses paid out of that.
That's
and 99.99% of the people in this country have no idea, do they?
No, and it's why we mention it. I mean, we have full classes, by the way, Ron.
Tell us how to get to them.
Okay.
Go ahead. Sorry.
No, on our website, we have full classes on Coverdells and HSAs and several of the other topics that we've touched on today.
Okay. Tell us how to get there.
It's www.questira.com, and that's spelled QUESTIRA.com, questira.com.
All right. There you have it, folks. questira.com, and not only will you be able to open an IRA there by filling out a form, which will take you 10 minutes, but you could also open one for your spouse and make sure they're a Roth, and frankly, get yourself kids a CISA. And should they open a Roth for their kids while they're at it? What do you think?
As long as the kids have earned income, a compensation type income. I mean, the Gerber baby was recently appointed. It's going to have income. That Gerber baby could open a Roth IRA. But if you're just doing
okay,
you got to.
So the kid has to have earned income, but they don't need earned income for a CISA, do they?
No, they don't.
Okay. All right. So you got any kind of a special offer for our listeners, or do we need one?
Well, it depends on how long you're going to play this. But for this month, we actually do have a wonderful special, and that is that if you want to transfer from another custodian, a self-directed custodian, you want to try Quest, we'll give you the rest of the year with the plan, the family plan, which means you only have to pay for wire transfers and overnight mail for $100 for the rest of the year. That's our introduction to if they want to try us out for free, if you know what I'm saying. But that's the end of May of 2018.
To be clear, did you say that I could transfer all of my accounts for $100 or 100 each?
It's 100 per account.
Okay, and there's no penalty. In other words, transferring an account from house A to house B is not any kind of a withdrawal and doesn't hurt me tax-wise, does it?
That's correct.
All I do is fill out a form and relax and let you guys do the work, huh?
That's right.
Okay, and then when you get it, you notify me that you have it, and then it's in a self-directed IRA, which only us, not you, makes a decision on what it's invested in. And we didn't touch on that, but you don't recommend any kind of investment advice, do you, Quincy?
No, I don't.
All right. So it's our money, and we get to do with it as we see fit, as long as we comply with the rules. And, I guess we could do it and not comply with the rules until we get caught, but not a good idea.
Right.
All right. Well, look, I'm out of questions. So I thank you for taking the time to spend with us today. This has been a very informative podcast, and I hope all of you guys go out there and get yourselves an IRA opened, questira.com. I cannot think of one good reason why you should not have your IRA opened, and that's assuming you know nothing about real estate. Get it open and start thinking about all the cool things you can do with it. And maybe when you get a chance, sit down and figure out the difference between taxed and tax-free, or have somebody else do it for you. And that'll help you make the decision, because tax-free grows many times faster than taxed. I don't care what the amount is or what the time frame you plugged in. So thank you, Quincy. Appreciate your time. Thank everybody for listening, and I will see you on the next Mentor podcast.
Thank you, Ron.
Okay, in case you didn't know this, I happen to have a course about IRAs, and guess who helped me create this course? None other than Mr. Quincy Long. He sat beside me all day long, and I tried to keep him awake while we went over about 10 times more than we've gone over on this podcast. You can get this course at the link below, and if you get down there pretty soon, you're going to get a $200 discount. The whole course is only $297 because you're a listener to our podcast. We want to reward you. You'll find this very entertaining, and in the back, there's actually 3 trust agreements: land trust, personal property trust, and a paper trust. They're all in the back. And you'll also find a section in there where we covered the dark side that Quincy and I have been discussing here, what you cannot do. Fortunately, we had a lot more time to go over each of those issues. So if you're interested in what we're talking about today, you might want to go check that out while this $200 discount is still up. You're going to have to hurry because it's not going to stay up very long.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.